We're going to analyze CVS Health and Walgreens Boots Alliance as investments, and we're going to do it all in 90 seconds. You want to keep up with stocks, but you don't have the time to read a lengthy report on every company that interests you. You're busy. I get it. I respect that. So I took the most important considerations from my research and packed it into 90 seconds. Use this to decide if it's worth your time to research further, to keep up with stocks you already own, or to just check in with some of the largest companies in the world. Fair warning, I'm obviously going to go fast. Let's put up a clock and let's do this. CVS and Walgreens are both primarily known for the U.S. pharmaceutical retail businesses, although CVS operates in additional related segments and Walgreens has a fairly significant international presence. As of this taping, they both have a market capitalization of just over $60 billion and a share price of around $65, and boast around 10,000 domestic locations employing over 200,000 people each. If you're considering adding a pharmaceutical retailer to your portfolio, should you buy CVS or Walgreens? That is the question. On the surface, these companies are surprisingly similar, but as we dive into the details, we can identify some key differences. Here are a few reasons you might prefer Walgreens. Recently, CVS's debt level has spiked, giving Walgreens a better debt profile overall. For example, Walgreens' debt to equity ratio is 0.6 versus CVS's 1.7. Their debt service coverage ratio is 45% versus CVS's more concerning only 11%. Insider ownership in Walgreens is almost 15% versus CVS with less than 1%. It's always nice to see the vote of confidence from those who are most familiar with the company and its prospects. Speaking of ownership, only 62% of the shares outstanding are held by institutions, compared to 86% of CVS's shares. So there's a lot more room for additional institutional interest to be a driver for future Walgreens price appreciation. Here are a couple reasons you might prefer CVS. Despite the fact that their earnings growth last year was significantly higher than the industry, and especially Walgreens, and the fact that their growth next year is projected to be slightly higher than Walgreens and the industry, the company's PE is quite a bit lower than both. And although both companies pay a stable, consistently increasing dividend, CVS's yield is over 3% compared to Walgreens at 2.5%. All in all, they both seem to be pretty stable companies, each having been around for over a century. They both pay a healthy dividend and have projected future cash flows to support an even higher valuation. But if you had to choose, Walgreens or CVS? Less debt with a more potentially catalytic ownership profile, or higher dividends coupled with higher growth? I look forward to continuing this discussion in the comments. If you found this helpful and would like to see more, don't forget to like and subscribe and click the bell so that you can keep up with all the companies we cover as we continue to help you build your rapidly growing, highly diversified net worth. I'll see you in the next one. Take care.